Looking for a high-quality, debt-free business to invest in? Does a market-beating yield and double-digit dividend growth sound appealing to you? Want to buy a stock on sale after it's dropped by 40%? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a leading home furnishings retailer catering to higher end clientele. Two interrelated trends have been going gangbusters over the last 2 years: home improvement and work from home. What do they have in common? Increased spending on home furnishings, which plays right into this company's hands. And that means more revenue, more profit, and more dividends. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explained exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Williams-Sonoma Inc., which appear to be trading at a significant discount today. Williams-Sonoma Inc., stock ticker WSM, is a multi-channel retailer of high-quality home products and furnishings. Founded in 1956, Williams-Sonoma is now a $10 billion by market cap retail beast that employs more than 16,000 people. The company's reported segments break down by brand. Pottery Barn, 37% of fiscal year 2020 sales. West Elm, 25%. Williams-Sonoma, 18%. Pottery Barn Kids and Teen, 15%. Other, which includes international franchise operations, accounted for 4%. Almost all of the company's sales are US based. In my opinion, today's retailer needs two big things to thrive. First, they must properly implement and communicate differentiation. Second, they must have a successful, cohesive, omnichannel strategy. Regarding the first point, Williams-Sonoma does this through unique brands within a niche space. They're not trying to be all things to all people. Instead, they provide attractive home furnishings that still offer a great value proposition relative to the quality. Regarding the second point, Williams-Sonoma has been perhaps better than any other retailer on the omnichannel front. Here's what the company has to say about this in their most recent annual report, and I quote, "Our e-commerce channel has been our fastest growing business over the last several years and represented more than 70% of our net revenues and profits in fiscal year 2020, unquote. By the way, this isn't new. It's not a pandemic story. Williams-Sonoma has clocked in 50% plus of sales through e-commerce for years. Simultaneously, they showcase their products in a beautiful retail store format that convey a sense of attainable luxury. With the sharp rise in the work from home trend playing out, and with home renovations being all the rage, Williams-Sonoma has found their planning and hard work over the years paying off even more than usual. But make no mistake about it, Williams-Sonoma, because of the 2 points I touched on, has been thriving for a long time, and I think they'll continue thriving for a long time to come. That should translate to them increasing their revenue, profit, and dividend for years into the future. As it sits, the company has increased its dividend for 16 consecutive years. The 10-year dividend growth rate is 13.9%. If you think that's impressive, their most recent dividend increase was a monstrous 20.3%. That double-digit dividend growth comes with a starting yield of 2.1%. This market-beating yield is close to its own 5-year average. And with a very low payout ratio of 21.4%, the company has plenty of room to continue aggressively increasing the dividend. Very healthy dividend metrics here. The yield might not be super high, but the high dividend growth rate offers an appealing compounding proposition. Looking at business growth, Williams-Sonoma increased its revenue from $3.7 billion in fiscal year 2011 to $6.8 billion in fiscal year 2020. That's a compound annual growth rate of 7%. Very solid top-line growth. Meantime, earnings per share advanced from $2.22 to $8.61 over this period, which is a compound annual growth rate of 16.3%. Really incredible. Prolific buybacks and margin expansion combined to power a lot of this excess bottom line growth. Regarding the former point, the company's outstanding share count is down by 26% over the last 10 years. Looking forward, CFRA is forecasting that Williams-Sonoma will compound its earnings per share at an annual rate of 7% over the next 3 years. CFRA clearly sees a material drop in Williams-Sonoma's earnings per share growth over the next few years compared to what the last decade has resulted in. I don't see CFRA's proposition as unreasonable. That's because the pandemic likely caused a near-term pull forward of sales from trends like work from home and home renovation suddenly taking off. I wouldn't expect the last 2 years to be indicative of a sustainable long-term growth rate for the company. On the other hand, Williams-Sonoma has stated that it's on a path to $10 billion in revenue by 2024. That would represent a top-line compound annual growth rate of 10%. Continued buybacks alone could give the company the ability to grow its earnings per share at a rate which exceeds that level. If we take CFRA's forecast as the base case here, I think there's still a lot to like. The low payout ratio means the dividend can be increased at an even higher rate than that 7% mark over the foreseeable future. In fact, I wouldn't be surprised to see Williams-Sonoma continue to raise the dividend at a double-digit rate over the next few years, if only to settle down into a more viable, higher single-digit range over the long run. And with a 2% plus starting yield, that's a compelling scenario. Moving over to the balance sheet, the company has the best financial position you could possibly have. The company has no long-term debt. They've been an excellent steward of capital, in my view. And they have a lot of financial flexibility in terms of funding internal growth, buybacks, possible M&A, and of course, dividend increases. Profitability is another strong suit. Over the last 5 years, the firm has averaged annual net margin of 7.1% and annual return on equity of 35.1%. Speaking on the margin expansion I noted earlier, the company is logging double-digit net margin right now. They were routinely printing annual net margin in the 6% range 5 to 10 years ago. In my opinion, Williams-Sonoma is a wonderful business with excellent fundamentals across the board. And they also benefit from durable competitive advantages, including brand strength, a successful omnichannel strategy, economies of scale, and vertical integration. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While I see regulation and litigation risks as relatively low in this particular industry, Williams-Sonoma faces extremely fierce competition in a highly fractured market. The lack of switching costs is a risk, although the company's brand recognition does mitigate this risk somewhat. There is exposure to the housing market and the cyclicality that brings. If home sales fall, demand for luxury home furnishings will naturally decline. Issues with the global supply chain could weigh on near-term results. The company also faces volatility around input costs. These risks should be kept in mind, but the quality of the business still makes it an appealing long-term investment idea. That's particularly true after the stock has dropped a stunning 40% from its recent high and now looks significantly undervalued. The stock's price-earnings ratio is 10.1. That's less than half that of the market's earnings multiple. It's also way off the stock's own 5-year average PE ratio of 16.1. We can also see a disconnection in the cash flow multiple. The price-to-cash flow ratio of 7.8 is quite a bit lower than its 5-year average of 9.1. And the yield, as noted earlier, is close to its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 8%. That dividend growth rate is at the high end of what I ordinarily allow for, but I think this business deserves it. It's actually much lower than the demonstrated long-term dividend growth, and EPS growth has been about twice as high as this level over the last decade. I do see moderation in growth going forward, which will lead to less spectacular results, but the low payout ratio gives the company a lot of leeway in terms of future dividend raises. I don't think this is an aggressive target for the company to meet. The dividend discount model analysis gives me a fair value of $153.36. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Williams-Sonoma as a 5-star stock with a fair value estimate of $209. CFRA rates Williams-Sonoma as a 4-star buy with a 12-month target price of $225. I came in surprisingly low. Averaging the three numbers out gives us a final valuation of $195.79, which would indicate the stock is possibly 46% undervalued. Here's the bottom line, guys. Williams-Sonoma Inc. is a high-quality, debt-free, niche retailer that has successfully built out a cohesive omnichannel strategy that's positioned to continue benefiting from numerous trends playing out. With a market-beating yield, double-digit dividend growth, a very low payout ratio, 16 consecutive years of dividend increases, and the potential that shares are 46% undervalued, long-term dividend growth investors would be wise to consider adding this stock to their portfolios after the 40% drop. And now for a special news announcement. Innovative Industrial Properties Inc., stock ticker IIPR, just announced Q4 results for fiscal year 2021. They knocked it out of the park, beating on both the top line and bottom line. Revenue was up nearly 60% year over year. Adjusted funds from operations grew by 42.3% year over year. Huge numbers. I've covered this unique medical cannabis REIT numerous times on the channel. If it's not already on your radar or in your portfolio, it's time to take a look. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It'll allow me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.